Imagine waking up to a life where your money is actually out there working for you. A life where the clink of pocket change is completely replaced by the sweet, sweet sound of dividends just effortlessly hitting your bank account. Picture a world where financial freedom isn't some distant pipe dream, but an actual, everyday reality. Welcome to This Explainer. Today, we're going to explore exactly how building a secret money tree of passive dividends can absolutely transform your financial future.
You know, when most of us think about kicking back and retiring comfortably, we usually run through the exact same list of options, right? Maybe a reverse mortgage, downsizing, or selling off our prized possessions. But what if your money just worked for you instead? There's this entirely different route that constantly gets overlooked, and it involves living entirely on investment dividends. It's a strategy where your investments spin off a consistent income stream, meaning you get to enjoy the fruits of your labor without ever actually touching your original principal.
To make this super concrete, let's bring in our avatar for today's journey, John. Now, the average person spends about $67,000 a year, but your ideal number really just comes down to the lifestyle you want. Let's say John runs his numbers and he wants exactly $2,900 a month. Over a year, that equates to $35,000 of pure passive income. Throughout this explainer, we're going to use John's goal to measure exactly what it takes to hit true financial independence.
Okay, let's dive into this. Here is our roadmap for John's journey. First, the fundamentals. Then, covered call ETFs, high-yield REITs, dividend aristocrats, and finally, funding your freedom.
Section 1. The fundamentals. Just as a super quick refresher, when a company turns a profit, they can actually distribute a slice of that cash directly to shareholders like John.
The ultimate yardstick we'll be using today is the dividend yield. This is basically just a measure of how much you're earning from dividends compared to the actual price of the stock. Now, yields vary wildly from company to company, but as a general rule, you'll find that older, more established companies offer higher dividend yields than the newer startups.
And the math, it is beautifully simple. You literally just divide the annual dividends by the price per share. So if you get a $10 payout on a $100 stock, boom, that's a 10% dividend yield. The absolute best part about this is that John's initial investment stays totally untouched while it continuously spins off cash.
All right, Section 2, covered call ETFs. If you want the absolute quickest path to living off dividends, you start right here. These unique funds give you a way to earn income from both stock appreciation and dividend payments.
Now, I know options trading has a notoriously complex reputation, but this strategy breaks down into a really logical three-step process, and the fund managers handle the whole shebang. Step 1. The ETF invests in a portfolio of stocks. Step 2. They write or sell call options on those exact same stocks. That basically just gives someone else the right to buy them at a set price within a specific time frame. Step 3. In exchange for selling that right, the ETF gets a premium. And that premium income is paid right back to investors like John as dividends.
Just look at the sheer size of these 12-month trailing yields. XYLD is sitting at 11.83%, OILK at 11.82%, and EWZ at 11.81%. I mean, double-digit yields are just massive compared to what you'd find in traditional dividend stocks. It's awesome because you're getting income from both regular dividends and those option premiums. But reality check, options can expire worthless, and if those underlying stock prices drop, it absolutely impacts the fund's overall performance.
Let's bring this back to John's goal of $35,000 a year. If he relied entirely on traditional dividend stocks with their lower average yields, he'd need an enormous portfolio of around $2 million. Insane, right? But with covered call ETFs and their double-digit yields, John only needs an investment between roughly $280,000 and $310,000. That is a shockingly accessible number compared to $2 million, and it lets him generate that steady income stream without locking up massive amounts of capital.
Moving on to Section 3, high-yield REITs. Think of a REIT kind of like a giant team pooling their money together to buy malls and apartments, and they are legally required to share the rent with investors.
And we brought the receipts for this one. Take a look at some of these standout companies. Two Harbors Investment Corp boasts a massive yield of 20.3%. Brandywine Realty Trust is offering 19.9%, and Orchid Island Capital sits at 19.4%. Those are incredibly high, right? Just keep in mind, these payouts rely heavily on a healthy economy and people actually paying their rent. So they can give you way more money than regular stocks, but they do carry some risk when the economy gets a little bumpy.
But even with those economic bumps, their historical data is super compelling. Over the past 20 years, REITs have shown a really solid average annual return of 10.8%. So this isn't just a flash in the pan. It's a genuinely smart way for John to potentially grow his wealth over the long haul, while still grabbing that reliable income.
So what does the math look like for John here? Assuming that historical 10.8% return, he'd need to invest roughly $320,000 to hit his 35 grand a year goal. And here is a very cool, unique perk. Unlike regular stocks, a lot of REITs pay out every single month. If John starts investing every week and lets those monthly dividends compound, he could legitimately hit financial independence in just 5 to 7 years. Next up, Section 4, Dividend Aristocrats. If you want absolute reliability and steady growth, you look no further than this incredibly exclusive group within the S&P 500.
To give you an idea of how elite this club is, just look at this number, 25. To actually earn the title of a dividend aristocrat, a company has to have consecutively raised its dividend payout every single year for at least 25 years in a row. Not just paid it, increased it year after year for a quarter of a century. Talk about a massive credibility boost.
We're talking about total heavy hitters here. Well-established household names like 3M, Leggett & Platt, and Walgreens Boots Alliance. Now, because these companies are so huge and established, their yields are definitely lower. On average, you're looking at a yield of around 7%. But honestly, what they lack in flashy double-digit numbers, they entirely make up for in pure consistency. They're way less likely to go under, and they perform far better during tough economic times, maintaining those profits to fund those ever-growing dividends.
Finally, Section 5, Funding Your Freedom. Because reaching your goal really just comes down to knowing your target number, your timeline, and your own personal risk tolerance.
And this brilliantly illustrates the whole picture. When we break it all down side by side, it's pretty eye-opening. Trying to get $35,000 a year from traditional stocks demands a staggering $2 million. But the alternatives? Dividend aristocrats get you there for a much more reasonable $500,000. High-yield REITs drop that to $320,000. And covered call ETFs offer the lowest barrier of all, at just $280,000 to $310,000. The ultimate game changer here is realizing you don't actually need to grind away for $2 million to buy your freedom.
Of course, everyone's situation is totally unique. John's magic number was $35,000, but you might find you can live perfectly well on less, or maybe you need more for your lifestyle. So I want to leave you with this final challenge. What is your target number for financial freedom? Take a second today, do your own math, and decide which of these strategies actually fits your vision. Because that secret money tree isn't a myth, it's completely real, and it's just waiting for you to plant the first seed. Thanks for hanging out with me for this explainer, and go let your money do the heavy lifting.